Are you listening? I need you to lean in close and really hear me. For months, maybe even years, you have felt the squeeze. The cost of everything has gone up. The price of borrowing money has felt like a lead weight on your dreams. You've watched mortgage rates climb, making the idea of buying a home feel impossible. You've seen the interest on your credit card balances swell, making it harder and harder to get ahead. You have been patient. You have been strong. You have been waiting for a sign, for a little bit of breathing room. Well, that moment may have just arrived. The financial tides are starting to turn. If you are smart, if you are ready, you can ride this wave to a more secure financial future. This is not a drill. This is not a time to sit on the sidelines. The decisions you make in the coming weeks and months could save you tens of thousands of dollars over the lifetime of your loans. This is your chance to reset, to refinance, to finally get that debt monster off your back. I'm talking to anyone with a mortgage, anyone with a car loan, anyone with credit card debt. I'm also talking to anyone with money sitting in a savings account. This change affects every single one of us. My goal today is to make sure you understand exactly what is happening so you can stand in your truth and take control of your money. You have worked too hard to let this opportunity pass you by. Let me be very clear. Opportunity does not knock, it whispers. And the whisper right now is about interest rates. The Federal Reserve, the institution that sets the tone for borrowing costs across the entire country, has finally made a move. They have cut their key interest rate. This is big news. It is the signal that the era of relentlessly rising rates is over, at least for now. But a signal is not a guarantee. You must be the one to act. Pick up the phone, check the rates, do the work. Your financial freedom is not something that is given to you. It is something you must claim for yourself, and the claiming starts today. Are you ready? Are you ready to stop being a victim of high interest rates and start becoming a master of your own financial destiny? Are you ready to learn the simple, actionable steps that can put more money back into your pocket every single month? If your answer is yes, and it must be yes, then stay with me. We are going to walk through this together, step by step. We will demystify the jargon. Look at the real numbers. Create a powerful plan. This is your moment. Do not waste it. This is your money, and it's time you told it where to go, instead of wondering where it went. All right, let's get down to the brass tacks. You hear the Fed on the news and your eyes glaze over. I get it. It sounds complicated and far removed from your daily life, but it is not. Think of the Federal Reserve as the country's financial thermostat. When the economy is running too hot and prices or inflation are rising too fast, they turn up the temperature by raising interest rates to cool things down. When the economy is getting too cold and they worry about a recession, they turn the temperature down by cutting rates to encourage spending and borrowing. What just happened is that the Fed decided the economy needed a little warmth. It has been a long, cold winter of high rates. Specifically, the Federal Open Market Committee, that's the group at the Fed that makes these decisions, voted to lower the federal funds rate. They announced this cut at their meeting last week on September 18, 2025. The cut was 0.25 percentage point, or what the financial world calls 25 basis points. Now, I know what you're thinking. Suze, 0.25 point? That sounds tiny. And you are right, it is a small step. But it is the direction of the step that matters. It signals a major policy shift. After a long and painful series of rate hikes designed to fight off the worst inflation we've seen in decades, the Fed is now saying, okay, we've done enough. It's time to ease up a bit. So why now? Keep prices stable, maintain maximum employment. For the past 2 years, their entire focus has been on taming inflation. They raised rates aggressively to make borrowing more expensive, which slowed down spending and brought prices under control. It was painful medicine, but recent data shows it has been working. Inflation has been steadily cooling off, getting closer to the Fed's 2% target. At the same time, there have been signs that the high rates were beginning to put too much of a brake on the economy, risking a slowdown in job growth. The Fed acted now to strike a balance, to ensure the economy can continue to grow without letting inflation flare up again. This is what you must understand. The Fed does not act on a whim. They are looking at mountains of data. Inflation reports employment numbers, consumer spending, global economic conditions. Their decision to cut rates is a calculated move based on the belief that the worst of the inflation fight is behind us. It is a vote of confidence in the economy's resilience. For you, it means the headwind you have been fighting against is finally starting to turn into a tailwind. This single, small rate cut is the first domino to fall. and it will trigger a chain reaction across the entire financial system, impacting everything from your mortgage to your savings account. Mortgage savings account. And that is where your opportunity lies. Words are one thing, but numbers are another. Numbers are your truth teller. So let's look at the real data, the figures that show you exactly how the financial landscape has shifted. Before the Fed started its hiking cycle back in 2022, you could get a 30-year fixed-rate mortgage for around 3%. Then, as the Fed relentlessly raised rates, we saw mortgage rates soar, peaking at over 7.5% in late 2024. That increase could mean over $1,000 more per month on the same home loan. It priced millions of people out of the market. But now, with the Fed's pivot, the tide is turning. In the weeks leading up to the cut, rates had already dipped to around 6.75%. Now, we expect them to drift closer to 6.25% or even lower in the coming months. Now, let's talk about your debt. That plastic in your wallet? It's been costing you a fortune. The average credit card annual percentage rate, or APR, skyrocketed, climbing from around 16% to a painful average of over 21%. If you are carrying a balance, that is a brutal interest rate that makes it nearly impossible to pay off your debt. The Fed's rate cut will slowly, and I mean slowly, begin to trickle down to these rates. You may see your variable rate card's APR dip by that same 0.25% within a billing cycle or two. While it's not a massive drop, it is a start. The same goes for personal loans and auto loans. New loan rates will start to be priced more attractively, perhaps falling by 1/4 to 1/2 percentage point over the next few months. But there is another side to this coin, and it affects every saver out there. For the past 2 years, you have finally been able to earn a decent return on your safe money. High-yield savings accounts, which were paying next to nothing before 2022, have been offering incredible yields of 4.5%, 5%, or even more. Certificates of deposit, or CDs, have been similarly attractive, allowing you to lock in a great rate for a year or 2 years. This has been a blessing for emergency funds and short-term savings. However, the Fed's rate cut is a direct threat to these high yields. Banks will not hesitate to lower the rates they offer on savings. We will likely see the top high-yield savings account rates fall from over 4.75% to closer to 4.25% very soon. So you see the push and pull? This is the new reality. Borrowers are about to get a break, while savers are about to see their returns diminish. The key is to know which side of the equation you are on for each part of your financial life. Are you a borrower with a mortgage? You have an opportunity. Are you a saver with a large cash position? You need to have a strategy. Understanding these numbers is the first step. It is not about being a financial genius. It is about paying attention to the few key metrics that directly impact your wallet. Look at your own statements. Know your mortgage rate. Know your credit card APRs. Know what your savings are earning. Knowledge is power. In every financial shift, there are winners and there are losers. My job is to make sure you end up in the winner's circle. The most immediate winners are people with mortgages, especially those who bought or refinanced when rates were high. If your mortgage rate is 6.5% or higher, you're in a prime spot to consider refinancing. Cutting 1 percentage point could save you hundreds a month and tens of thousands over the life of the loan. That saving can build your emergency fund or be invested for retirement or pay for college. Home buyers waiting on the sidelines will also win. Benefits extend to anyone taking a new loan. Auto loan costs will start to fall. Personal loan terms to consolidate debt will improve. This is a crucial point for anyone drowning in credit card debt. While the rate on your existing cards will only dip slightly, a lower rate personal loan could be your lifeline. Use it to pay off high APR cards and consolidate into one manageable payment with a much lower fixed rate. It's a classic good debt versus bad debt move, more powerful in a falling rate world. But there's another side. Savers will feel the pinch. For 2 years, you were rewarded with high-yield savings and CDs. Smart, conservative choices paid off. But now those returns will decline. Banks are businesses, not your friend. When the Fed cuts, banks often lower deposit rates to protect margins. Your 4.75% APY could become 4.5%, then 4.25% with further cuts. This creates a dilemma. Safe cash is less productive now. That hits retirees and income-reliant savers hardest. The easy money era for cash is ending. Don't abandon savings. Keep an emergency fund of 8 to 12 months in a safe, liquid account. But think differently about cash beyond that. You need a plan. Letting a large sum get lazy is a mistake you can't afford. Okay, enough talk. It is time for action. A plan without action is just a dream. We are here to make things happen. Your first and most important action item is this. If you have a mortgage with an interest rate above 6.5%, investigate refinancing. Do not wait. Check your credit score. Aim for a strong score, ideally 740 or higher. If your score isn't there, find out why and improve it. Then call at least 3 different lenders. Call your current lender. Call a local credit union. Call a reputable online mortgage broker. Get quotes from all of them. Compare interest rates. Compare closing costs. Compare the terms. Make them compete for your business. This is non-negotiable. Your second action item is to attack your high-interest debt with a vengeance.